good soldier, choosing your battle. Pick yourself up and dust yourself off and back in the saddle. You're on the front line, everyone's watching. It's serious, we're getting closer, this isn't over. The pressure's on, you feel it, but you got it all, believe it. When you fall, get up, oh, oh, and if you fall, get up, eh, eh. Tamina, mina, sangalewa, cause this is Africa. Tamina, mina, eh, eh, waka, waka, eh, eh. Tamina, mina, sangalewa, this time for Africa. Listen to your God, this is our motto. Your time to shine, don't wait in line, y vamos por todo. People are raising their expectations. Go on and feed them, this is your moment, no hesitation. Today's your day, I feel it. You pave the way, believe it. If you get down, get up, oh, oh. When you get down, get up, eh, eh. Tamina, mina, sangalewa, this time for Africa. Tamina, mina, eh, eh. Waka, waka, eh, eh. Tamina, mina, sangalewa, anawa, ah, ah. Tamina, mina, eh, eh. Waka, waka, eh, eh. Tamina, mina, sangalewa, this time for Africa.
I'm well on my journey, biggie, biggie mama, 1 A to Z. My sister's all on my journey, biggie, biggie mama, from east to west. My tea, waka, waka, my eh, eh. Waka, waka, my eh, eh. Sangin' sin, summer, sin.
Switching on a light shouldn't be this complex. Neither should choosing where to invest your money. With Cinnabar Investment Management, we take the complexity out of investing, ensuring the right fund for the right investor every time. Cinnabar Investment Management. Complexity simplified.
Good morning, everyone, and welcome to this fourth quarter report back and feedback session from us at Cinnabar. Today we've got quite a few people in the audience. We have a number of wealth managers, financial advisors, and we're lucky to have many of their clients having joined us as well. So welcome to everyone. I hope that today's session is going to be interesting, a bit of fun. And I hope that at the end of the day, you leave with a nugget, little golden nuggets that gets dropped down through the presentation that you can use in your daily life and hopefully improve your financial situation. My name is Alex Cook. I'm the CEO of Cinnabar, and today we've got a great agenda. We're going to start off just with a business update, and then we're going to move on to discussing the tenets of financial freedom, 5 golden rules for financial freedom. I think just roll them all out, Cam. The 5 golden rules to financial freedom, and we decided to include this after consulting with a number of wealth managers and their clients where they've unfortunately been exposed to a Ponzi scheme and they've lost enormous amounts of their wealth. And when something terrible like that happens, it's often good to just get back to basics. And a core part to the Cinnabar ecosystem is the financial technology that we we embed within all of our clients. And today we're lucky to have Arrie Pieterse join us. So Arrie is the head of product for Wealthbit. He's the person who decides what is going to get built next within the system. So I'll give a brief presentation just on these 5 golden rules that anyone can apply, and they're really, really simple. And then Arie's going to give a demonstration of how you would apply these in the tool to make it really easy. Brendan de Jongh's then going to take us through a market review and an outlook for 2024. So he's going to gaze into that crystal ball and tell us what's going to transpire. Looking forward to those rand predictions, Brendan. And then Geoff Blount's going to take us through what the previous year's performance was like on all the portfolios, and what the portfolio construction looks like right now, and then how it's likely to change over the course of the next quarter. And then Zahid Hatiz, a new addition to Cinnabar, which I'll introduce quite shortly. He's going to be taking us through what to expect this year, and then I'll wrap up. As always, post as many questions as you would like to in the chat box. We're going to have a fair length of time at the end of the session to ask questions as well. So please ask as many as you can. Let's make this interactive. So moving on to the business update, after going through our purpose. So our purpose, and we like to start with this because we actually start every internal meeting with two items. First is our purpose, and the second are our core values. This is our purpose: to create and protect intergenerational wealth. And it's probably one that resonates with most of us. Our core values, and this is what we'd like you to hold us accountable to, is that we always invest effort for value. So we don't like wasting effort. We always expect everyone within our team to challenge every decision, every move we make to the portfolios, but don't be disagreeable. So come with a good argument. We strive to make everything simple. So this is a very complex world, and the investment world is quite complex. We do our very best to rationalize it down to be simple for our wealth managers, financial advisors, and also all of their clients. It shouldn't be complex. We've got a hunger for growth, and this is a growth for each of us as individuals, also for our country and people that work with us. And then our last core value, and it's arguably the most important one, is that we approach investments independently. We're not tied to any large product house. We're not tied to any large insurer. No insurer owns any of us. And that's very important for us, but it's probably even more important for our clients. So we're not going to be making decisions because a big brother says we have to. And I think that's very important. In terms of our Cinnabar ecosystem, so and I've been thinking about this yesterday. When I used the analogy of a vehicle. So back in the day, if you bought a vehicle in the early 1900s, it was meant to get you from A to B. It was meant to get you from one place to another place. And often it didn't, because they broke down. In fact, when I was in my early teens, and sort of all the way up to age 20, I frequently remember vehicles breaking down. These days, vehicles don't break down that often. You very rarely see a vehicle by the side of the road that's not working anymore. Back in the day, air conditioning and electric windows were sort of nice to haves. Nowadays, I dare to say that almost all of our cars have aircon and electric windows. But then we started to add extra features to vehicles, features like ABS, traction control, features which improve the safety. And I think this is a beautiful analogy to see with investments, where we expect the portfolios over time to deliver on their outcome, to deliver on their objective. So we expect them to perform well. The ecosystem we've created takes that into account, but it also looks at other factors. And these other factors we think are going to start becoming the norm within the investment space. So the first one is that we need to make sure that people that are working with us are profitable, and we want to help them help make their businesses more profitable, because if they are profitable, they're going to look after more clients, they're going to remain in business, and people are going to be advised. So each one of these core tenets of the ecosystem serves some purpose towards getting more individuals towards a state of financial freedom. The second part is the use of cutting-edge technology. So I remember when I started in this profession about 24 odd years ago, the overarching reason that advisors were in business was to sell something to somebody else. And that's slowly changing. It's slowly changing where advisors are far more focused on actually giving holistic advice to clients and involving the clients in their own financial plan. So that's where Wealthbit comes in. A part of Wealthbit that gets produced is something called the enriched consolidated data set. And it's almost a byproduct, but it's a very, very useful byproduct. Because what this does is it consolidates data from all providers, whether you're with 91, Allen Gray, Coronation, Liberty. It looks at everything, not just on a per company level, but on a consolidated view. That consolidated view is then used to analyze every single client's portfolio and figure out whether they are over-risked or under-risked, or if they're the correct risk profile, are they achieving the best return they can be achieving for that given risk. So that's where the book risk analyzer comes in, and it puts power into the advisor's hands. The next phase is to have a lot of support. Wealth managers or advisors' best time is spent with clients, advising clients, helping more clients get to a good situation, a good financial situation. Their time is not best spent preparing a presentation on why to choose fund A, B, or C. That can be done by a really streamlined back office team that we've put in place. And then the final component to this ecosystem is at some stage, the wealth managers or advisors look to slow down. And when they look to slow down, it should not affect their clients' ability to achieve financial freedom. So we help out with succession planning as well. And that is the fifth component to the ecosystem, all centered around assisting individuals achieve financial freedom. So we've been strengthening the ecosystem over the past quarter quite a lot. The first exciting announcement is that Zahid has joined as head of distribution for Cinnabar. So he's come into an asset management business. He's got more than 20 years experience in financial services, partially spent with wealth managers in the wealth management space, and partially spent in the in the asset management space. So he's got both strings to his bow. And this is very useful when assisting clients with presentations, because he's licensed and he understands financial planning very, very well. We've enhanced our internal operations significantly, and we've made that book risk analyzer more automated and also more aesthetically pleasing. It looks beautiful now, and that's compliments of Renee, who's in our team. And then we've also made a very, very big decision. We've been asked for a number of years now to launch a global equity fund, of fund, and one that's domiciled overseas. And we've made the decision this year to actually launch it. So we'll start paperwork probably this week, and we hope to be launched by the end of next quarter. So that's a bit of an update. What I'm going to hop into straight away is to share my screen, and I'm going to take you through something that we call the 5 golden rules. So Cam, I'm probably gonna muck this up. So just tell me if it's not working. And it shouldn't be working yet. I haven't pressed share. Let's see. Cam, is that working?
Yeah, there we go. That's it.
Excellent. Good. So Wealthbit is financial technology, and the focus for Wealthbit is all around financial freedom. How do individuals achieve financial freedom, and how do you make it really, really simple? So we do a number of workshops, a number of companies, and the complimentary workshops just to raise awareness of financial freedom and give people hope that everyone can achieve financial freedom. And this is an extract from one of those workshops. So we hope you find it useful and interesting. You're probably going to find the demonstration a whole lot more interesting. So Arrie's coming on at the end, and he used to live in Korea. He now lives in Sandton. So he's made a move here, and you're gonna hear an American accent, which don't let it deceive you. He is South African. So this is the sad reality, is that 6 out of every 100 South Africans are going to be okay with regards to financial freedom. So look at it another way, 94% of the country will never, ever be financially free. And that's a stat that's often bandied about, but it becomes a lot more scary when you start seeing people around you that are not financially secure and they have reached an age of retirement. It's actually it's horrible, and that's the reason that we have this strong purpose within Wealthbit. And it seems impossible to people for a number of reasons. That you might feel you don't earn enough to save, you don't know where to start, you don't know who to speak to. Retirement often seems so far in the future that it's tomorrow's problem. It's my future self's problem, not my today's self's problem. Inflation is frightening. So I was with my son, and I said, well, for you to achieve a 40,000 Rand income in today's terms at age retirement, he'll need about 250 million Rand. It is frightening. So to wrap our head around the impact of 6% every single year with prices going up is quite tough. Kids' education, I mean, schooling is not cheap, and it's not just the schooling, it's all those other extra bits and pieces like school uniforms and school tours and so on. Taxes, and then medical aid. Medical is often people's biggest single expense line item, and it's not going down, it's going up by more than inflation. So financial security does seem impossible. And many studies have been done on this, where this is a very large one done by a company called Debt Busters, and they surveyed 35,000 South Africans, which is a big number. And of those 35,000, 78% of them experienced financial stress. 94% felt it was affecting their work, and 77% believed it was affecting their health. And I see this all the time when we speak with individuals. It's true. It does affect the health. And there's good news, though. So the good news is that anyone who has a job can achieve financial freedom within 240 months. So that's absolutely anyone. The irony is the more debt you have, the easier it is to achieve financial freedom. But we'll get to that later. So it's good news. And I'd like us to hold on to that good news. And this is just simple maths. It's just simple maths. Just a little bit for a long period of time equals financial freedom. Most people achieve it within 10 years, so within 120 months. And we've developed these 5, we've called the famous 5. So for those of you who are old enough to read Enid Blyton, that's kind of where we got the inspiration from. But the famous 5 golden rules. And the first one is to define life objectives. So too often we see that people start out on this journey of life, and at the end is death. We know that, but they have no actual goal that they're going towards in their life's race. They have 5-year stints or 10-year stints at a time. And by planning 10 years or 5 years at a time, it means that you could be going in entirely the wrong direction for 5 years. So it means that instead of worrying about going in a race to a 100-kilometer race, you could be going 10 kilometers in the wrong direction, which means you've actually got a 110 kilometers race. So we really advocate strongly that start with the end in mind. Figure out what your end purpose is, and then develop a path backwards to achieving that end purpose. That doesn't mean there's going to be a straight line. It might still be a bit of a wonky line, but it's going to be a whole lot straighter than if you're only planning 5 years at a time. Now, but defining life's purpose, what you do is 2 very, very important things for your finances. You first of all figure out how much money is required to achieve that purpose. The second thing you figure out is what your non-negotiable date of financial freedom is. Now, this does not mean retirement. In fact, we almost want to obliterate the word retirement from all of our literature. We want to head just towards financial freedom. Financial freedom is that date at which you have enough capital that you don't need to work. We don't believe you should stop working, because people that stop working get old and then they die. People that keep on working or will continue to have a sense of purpose, they tend to stay younger. We see this time and time again. So the life objectives is the first of the famous rules. Get your life objectives and write them down, and then plan it out. Then don't rush this process. It can take a while. One very, very useful trick to achieve this is to actually do what one of my mentors in San Francisco asked me to do one day. He said, Alex, and he's an Israeli guy with a thick Israeli accent, said, today you're going to write your eulogy. I thought, oh, it's a bit heavy, writing a eulogy at whatever age I was. But he said it gets worse. At the end of the session, you're also going to read back your eulogy to me, and you're going to tell me who at your funeral is reading that eulogy. So I found that to be quite a cathartic exercise, where at the end of it, I had a very, very clear vision as to what I'd like the end to look like. And from there, I simply worked backwards to today, and then mapped out a process to achieve that eulogy result. Quite heavy. It is quite heavy, but it's a really, really worthwhile exercise. We've written a course on how to write a eulogy, which we can get to at some stage. Second of all, budgeting. Give every single rand a job. And do it like this. First of all, list monthly expenses, list debt repayments, list savings, sort them by order of importance. Then you will certainly have monthly expenses or expenses which aren't monthly, which are annual. So those non-monthly expenses, figure out what the monthly equivalent of them is and tuck those away into some savings pot that you can use at a later stage. Then plan for each rand of your net earnings. So whatever you earn, take tax off, you've got a net amount. Plan for every single rand until there is naught. If there is less than naught, then go back to your budget and figure out what you've got to cut out, because there can't be less than naught. The budget's got to balance. Not all countries believe in that. So budgeting, you'd have your salary. So let's say a salary of 80, provident fund of say 15%, taxes of say 18,000, leaves you with a spendable salary of 49,000. So that's the amount that you're going to be budgeting for. Most people have got a lot of debt, and this is normal. It doesn't mean it's good, but it's normal, and we're hoping to put tools into your hands to get this debt down. Then essential expenses are, in this case, 29,000, and the balance is minus 2,600. If this is your situation, I'm going to be quite brutal. If that's your situation and your balance is negative every single month, then non-essential expenses should be cut out. So restaurants, don't go to restaurants, don't do takeaways, don't do alcohol, don't do chocolates, don't do Coca-Cola, don't do holidays. No expenses, if that budget, no additional expenses, if that amount is in the negative. You've got to get your budget to balance. The other interesting thing is, although you're earning 49,000, your actual essential expenses are only 29,000. Your debt is what pushes it up. So if you can eliminate debt, then you're solving not for 49,000 to become financially free, but you're solving for 29,000 to become financially free. And it's a very, very big difference. So get that number to balance, and then get it positive, and then start saving, and life will get better. Third, eliminate debt. The more debt you have, the more capital you need to be financially free. So I think about that previous example where we had 49,000 in net salary and 18,000 of that was debt. If we're solving for 49,000 and we've got to replace 49,000, we need a lot of capital. If we need to replace 29,000 on a monthly basis, we need less. So we really view debt as modern day financial slavery. More debt means you need more capital, means you're going to be a financial slave. Don't be a financial slave. Let's get this debt monster squashed. And what we did here was we took the example in the previous example and showed you what zero debt financial freedom amount would equate to. So looking at these rows here, first of all, this is the post-tax budget. So whatever your budget is after tax, your pre-tax budget, this is how much you have to earn to develop that post-tax budget. And then the last row is the capital required in 10 years' time to be financially free. All right, so let's take the first one, with debt. So with debt, let's say your budget is 49,000. To deliver 49,000, you need to earn a gross 68,000. To replace 68,000, you need capital of 34 million. So your capital requirement is 34 million. Without debt, so now you've squashed that 18,000 Rand in debt, your post-tax budget is 31,000. So that's 57% less income is required. Or looked another way, your budget with debt requires 57% more income. But here's where it starts getting very interesting. The pre-tax budget is only 40,000, and you need 70% more gross income with debt. And the reason for that is that tax is not linear. So tax goes up exponentially. You've got different tax brackets. And if you can get yourself to financial freedom in a lower tax bracket, guess what? You need a whole lot less capital. 20 million versus 34 million. So you need 70% more capital if you have debt. So it shows you how important it is to get rid of debt and get rid of it as quickly as possible, because then it becomes a compounding positive effect. Without debt, if you don't increase your lifestyle, you have additional funds to invest into getting to financial freedom quicker. So you can get to this 20 million Rand number a lot quicker. So why do banks have big buildings? And yes, we all need things like cars and houses and whatnot, but just be very, very aware of how much extra you're paying if you have debt. And we just took two examples. The first is a car, and the second is a house. So let's say you buy a R500,000 Rand car, and these days that's not even an expensive car. It's quite crazy. Cost of vehicles has gone up frighteningly. So let's say that costs 500,000. The interest you're going to be paying over a 5-year period would be 168,000. So your 500,000 Rand car is not costing you 500,000. It's costing you 668,000. You're paying 33.6% more for that vehicle just because you have debt. So if you can buy cars cash, do. And even if it means you buy a cheaper car. With regards to a home, so we all treat our home as our biggest asset. Once again, it costs a lot more money than we think. So a 2 million Rand home over a 20-year period, we actually end up paying 3.2 million Rand in interest. So our 2 million Rand house doesn't cost us 2 million, it costs us 5.2 million, about 160% more. So it shows you how important it is to get debt squashed, debt at least that you're paying for, as quickly as possible. So if you have someone else paying for your debt, let's say you have a rental property, that might not be the end of the world. Somebody else is paying your debt. So how could you not get into debt? Well, the funny thing is, if you had to save those monthly repayments for a car, you could have a brand new R500,000 Rand car every 3 years. And none of us need a car every 3 years, by the way. They're reliable, they last for a long time. We don't need to be driving brand new cars. So that's on the car side. With a home, it's actually even more exciting, because with a home, we can, if we save the amount that we were paying on our home every single month, we could buy a brand new house valued at 2 million Rand every 6 years. It's actually quite phenomenal. Now you can think how easy life would be if you could get 3 homes within a 20-year period versus paying off 1 home. So top tactics for eliminating debt, and these are very, very useful, and they're quite easy. First of all, delaying purchases is a useful trick. Our chief operations officer often tells a story of a person he used to work with, an old guy, and he used to drive into work with him every now and again. And the guy always used to say, one more day. And eventually our CEO asked, why do you always say one more day? He says, every single time I drive past the car lot, I just say one more day. I can last for one more day in this car. And that one more day became 1 more year, became 2 more years. And he accelerated his path towards financial freedom really quickly. So by leaving it for 1 more day, it means that your capital works for you instead of you working for the bank. Because if you have debts and you're paying for it, you are working for the bank. You are making them wealthy, and that's why they have those huge buildings. Then think twice about the value of the car or the house you want to buy. Could you buy a more affordable house or a more affordable car? Would you be happy in that house or that more affordable car? What if it meant that it could take 4 years off that date at which you achieve financial freedom? If that was the reward for just holding off or just getting a slightly more affordable vehicle or home, would it be worth it? And then think very, very carefully about who you're actually buying things for. And we always use this sort of thought process where if you had to plant yourself in rural India, where people have absolutely nothing, would you need a fancy car, or would you want a really simple car? And the odds are you'd be very, very happy with a really, really simple car. So it makes you question who you're actually buying these expensive things for. Are you buying them for yourself because you must have them and not negotiable, or are you buying them to impress somebody else? In which case you're trying to keep up with the Joneses. So beware of this. It's so easy to fall into that trap where you buy a fancy handbag because all your friends have got fancy handbags. Handbags aren't my thing, but they are some people's thing. So eliminate debts. Next, build an emergency fund. And there are real emergencies. It's like medical emergencies, and they happen. They don't give you warning. They all of a sudden pounce on you, and then you want to come up with a deposit on a Saturday evening. That's a real emergency. Gearbox failure. That's a real emergency. You don't expect it to happen. It happens. Washing machine repair. We recently had our microwave break, and I asked Natalie, well, what's your plan? She said, oh, I think I'll just get a new one. And I said, well, what happens if we repair that one? And we repaired it for, I think, 500 Rand. It was an absolute bargain. And then, of course, zombie apocalypses. These are real things which might happen. So there are things which are not emergencies. And these are not emergencies. School fees are not emergencies. You know they're going to come. Every single year, you can be dead sure that you're going to have to pay school fees. Your tires are going to wear down. You are going to want to go on holidays. You're going to want to buy people presents. Those you need to plan for. Plan for in your expense category. Those are certainly not emergencies. Your emergency fund is for real emergencies. And we advocate building up an emergency fund as quickly as possible and use every which way that you can. So reduce investment contributions, get your debt repayments down to an absolute minimum, get your budget as low as you can until you've built up a decent emergency buffer. And that emergency fund buffer should be at least 3 months of monthly expenses. If you built up at least a 3-month monthly expense buffer, you'll be amazed at how financially free you become. Consider that buffer your bulletproof jacket for financial freedom. So that's building up an emergency fund. And the last one is to automate savings. So automating savings, it's effectively a way to do a job once, and once it's done, it's no longer in your mind. It just happens automatically. So the first thing is decide on your capacity to take risk. And this is where you need to decide what return you want to be targeting. And that will then determine what asset allocation you need to have within your portfolio. So how much property, how much bonds, how much in equity do you have within your portfolio? How much is local? How much is overseas? Second of all, set up a multi-managed portfolio. So we don't advocate ever giving all capital to a fund manager that's invested in shares. If they get their picks wrong, it might upset your entire situation. That's why all we manage within Cinnabar are all multi-managed portfolios. And they invest into a variety of other fund managers where no one component, no one fund manager has more than 10% of our clients' portfolios. Then, and this is a very, very important one, put an automatic increase on the savings, because you might forget to increase it next year. And if the automatic saving increase is there, it just happens automatically. And all of a sudden you'll wonder, why have I got a few $100 less in my bank account this month? That's why, but it's only a good thing. And then consider this an expense. So this must be considered an expense in your budget, where eventually you just get so used to not having that money in your bank account because it's busy working for you in your investments. So what we've been doing as Wealthbit is we've been going to a lot of companies. We've been rolling out a program that we call the Financial Freedom Coaching Program. And this is just for businesses who are looking to reduce financial stress and at the same time improve their profitability. So we've had some very, very interesting companies. A lot of accounting firms have come to us, a lot of consulting firms have come to us, and the program is quite simple. The people get access to Wealthbit. We give their companies an organizational dashboard. We then give them financial freedom workshops. And these financial freedom workshops are often the first part towards giving people hope in achieving financial freedom. We then arrange coordinated sessions with financial freedom coaches. And these are short, 15-minute sessions, 15-minute sessions that give people a path to achieve financial freedom. And after these sessions, most people realize just how simple achieving financial freedom actually is. And then we integrate that into their website, integrate the portal into their website. So that is a precursor to what the main event, which, Arrie, if I can hand over to you now to take us through a demonstration of Wealthbit. Arrie's been the head of product at Wealthbit now for going on 8 years. So he's been with the firm for a while, and what you're about to see is effectively his work. All right, take us away.
Great. Hey, everyone. Quite excited to share with you today the extension of what Alex has already shared with all of us. So while I'm just bringing this up, as mentioned, what we're basically going to do is we're going to step through Wealthbit, the platform that we've developed, and really just talk about some of the key principles to getting to that financially safe and secure place. Now, often talking about these ideas and sort of, exploring what can be done is difficult if you don't have a way to visualize it. And what we've done is built this platform that really makes it easy to visualize every decision that you make. So, what does it look like if you have a lot of debt? And what does your picture look like when that debt isn't there? And how does that actually impact your future? So what I've done is I've set up an initial plan that I'm going to run through. And just for a bit of context here, I've set up a budget, some income values as well. I've added 1 or 2 assets that I'll run through in a moment, and some liabilities. So those are the things that we typically pay banks for so that they can have the big, nice, fancy, shiny buildings. So the first detour in the app that I really want to make is going down to a budget. Now, a lot of times when people think about a budget, it feels very restrictive, right? That's the first thought that kind of comes into people's mind. And the truth is that if you manage a budget well, it actually provides you more flexibility and freedom in your life, and can actually be an amazing tool to help you live the life that you want more comfortably. So what we've done is we've added the ability here for you to do a detailed budget if you don't have an external budgeting tool, and you can go through and you can add everything both for your current situation as well as retirement. So you can add your rent or bond payments that you might be doing, internet usage, cell phone, groceries, all of these kind of expenses to really help you sift through and think through the things that you're spending on a month-to-month basis. And all of this kind of tallies up here into this expense breakdown to show you your current expenses. And then we automatically bring in your asset contributions, liability repayments, and this shows you your total expenses. So we've added a basic income here of 50,000 a month before tax, and our system automatically calculates the after-tax net income. So you can see that in this case, the total net income and the total expenses are pretty close to each other. And this is mostly pushed up because of this liability repayments that we have here of about 5,500. So what I'm going to do is I'm going to create a new scenario. This is one of the most powerful features of our platform, where you can actually create a scenario to draw out what does your picture look like comparatively to your current situation, should you make certain changes. And one of the key things that we might want to explore in this situation is, what does our picture look like, if we, for instance, add some cash flow events. So these are things that we might want to explore in the future, or actually ways that we want to live our life, right? So these are some objectives that we might have for ourselves. So we might want to go on holiday regularly. So we can add this in as well. And we can say, from this current year, we're going to do this every year for up until the age 60, just as an example. We also automatically apply inflation here, because this is that silent killer that year on year people forget about. And it actually impacts your plan quite drastically. So what we're going to do is just keep it at that 6%, but we can adjust it for different things like university fees or whatever, schooling fees that kind of escalate at a much higher rate on an annual basis. So what you can see is, even though this event here is possible on an annual basis, our capital has significantly dipped. And this basically means that we can see visually that by making this decision, we're in a financially worse position in the future, just kind of based on how our income and everything is structured. And we can see that our income doesn't last quite as long once we get to retirement. And we have this like fall off of a cliff here because we're withdrawing from our investments as well. So the tool really makes it easy to visualize what happens when I make these decisions. And you can add in anything like buying that new car or buying a house, or these kind of larger capital expenditures that are sort of hard to reason about, in other ways. The next point to look at here is liabilities. So we're currently stuck with a credit card and some vehicle finance here. And these two total up to 5.5 in a month that we need to repay. Before I remove those, what I'm going to do is I'm going to turn on this little toggle here, which allows you to see what happens when your surplus income is invested. So this is a very simple thing that we've implemented in the system that helps you basically visualize that if your net income is higher than your expenses and that difference is invested rather than spent, which we admittedly sometimes do, lifestyle inflation kind of keeps us where we are. Then what if we don't do that? What does our picture actually look like? So as you can see, we're kind of in this situation. So we'll have another 5,500 going into our investments. So if I delete the car first and then delete the credit card as well, then what we'll see is that money that we would have been spending, I go back to the budget once the numbers are crunched, liability payments drop down to 0. Our total expenses are 37, and our income is still at the 39,000 mark. And then you can see we're right back up, even though we have this holiday that we're spending annually, we're almost right back up to where we started. So that really shows you the impact of debt over time, even allowing you to be able to do the things that you want, like going on holiday. Because if you didn't have that credit card debt, you could easily save up that $2,000 a month to go on a holiday without straining your budget or without actually incurring more debt for that thing that you wanted. So it really becomes a game of sorts, but a game of prioritization to what is important to you, and really making sure that you're aligning all of your financial decisions to those things that are important to you. And then the other key aspect as well is building up a emergency fund. So this is something that you can also do by just adding in a money market account or something like that. And you can very easily see that as you add in capital to this, how this inflating value also kind of buffers your projection a bit. So because of this extra capital here, should we add a larger emergency, right, like 20 or 30,000 to our that might have happened, like a cash flow event, right? We need to repair car, and this might be another 20,000, and this happens this year as well because it happened. And now we can see, are we going to be okay? Well, we already have a bit of a buffer of cash there. And what we can see then is that, sure, it does impact things because previously that was kind of included there. But right here, we can easily afford that because we have some capital built up and we're not going into further debt, kind of further impacting our financial future. So these are some of the very essential ways that we've allowed people to really explore these ideas and bring themselves a sense of peace and calm when they think about their finances, because they're in control of actually planning and understanding how these various decisions kind of get them to a better or worse outcome. And then another thing that happens is that when you add in contributions to any asset, this obviously forms part of your budget as far as your asset contributions go. And then you can very easily see that, okay, this is my total expenses, and they're sort of considered as an expense part of your budget. So you don't really see them as sort of something that comes after your budget. And that's also how Wealthbit helps you to keep everything balanced and in check here. So yeah, that's basically everything that I wanted to run through from a Wealthbit perspective. So I'll hand over back to Alex.
Arrie, could I ask you to do one additional item, and that's to look at asset allocation? Because I notice this person's asset allocation is heavily in, I think, domestic cash.
Correct.
Yeah. So and how old is this person? This person is
they're at 30 right now.
30. Okay, so they should have a vastly different asset allocation. So if we were to just change their asset allocation.
Yeah, so let's quickly do that. So all of this money is currently sitting in a money market. And just to simplify this, we'll very quickly turn off these two cash flow events, which should bring us up to just a clean projection to have a look at. So at this point, we're looking at this projection, and we're going to end up currently with around 5 million at retirement in today's terms. And if we change the asset allocation here by removing the money market, so we'll delete that. And then we'll add a unit trust, which is where we can add a more aggressive portfolio. So we'll put in the 100,000 and add the 1,000 Rand contribution again. And then here we'll use our overall risk profile, which has a 10% targeted return, instead of a money market's typical 4%, which is obviously where most of our cash position was sitting. So now our asset allocation looks very different. And you can see that just because of that change, we're jumping from 5 million about at retirement at today's terms to around 8 million, which is a very, very significant impact. because of the time that we have for that.
Thanks. So yeah, it just shows how important it is to get your asset allocation right, and it's something that's often overlooked. And we often see people saving themselves towards poverty. So we need to accept that it's not going to be a smooth ride with a higher equity allocation. It's not going to be a linear ride, but it becomes very predictable over time if you keep your asset allocation correct. Amazing.
And much more impactful.
Yeah.
Great.
Arrie, thanks for your time. Thanks for joining us. It's been great having you with us.
It's been a pleasure.
Enjoy the rest of your day.
Thanks.
We've got, I'm excited to announce Brendan. Brendan is going to be taking us through an economic overview and showing us that crystal ball. Try and hold him to something. Brendan, over to you.
Thanks, Alex. Yeah, crystal ball makes me a little bit nervous. I'm not going to be doing too much of that, but I'm glad you mentioned asset allocation a little bit earlier, Alex, because I think ultimately the way you invest in your portfolio is really what's going to take your financial plan from where it is right now to that financial freedom that you were talking about at the end, and really how you structure that investment portfolio can really make or break you. So what I'm going to be talking about is what actually would have affected investors' portfolios over the last year or so. So I'll be going through a little bit of a market overview, and yeah, ultimately talking about the globe, which asset classes did well, and then a little bit more detail into that. All right, great. So what I have here is the calendar year returns for various asset classes, and these are asset classes that are typically found within a traditional South African investment portfolio. So this is global equity return in 2019 in rands, SA equity, global bonds, so on and so forth. And I think the first point to take out of this is just how much asset classes deviate. So not every asset class is at the top and not every asset class is at the bottom, and there's a lot of variation between all of these. But certainly what you can see here in 2019, 2020, and then also 2021 is global equities and global asset classes in general doing really, really well for South African investment portfolios. And unfortunately, South African equities not being able to keep pace with that. And then we had 2022, and that really was the onset of inflation. And to a large degree, we're still actually dealing with this inflationary problem and what it might mean for interest rates and the economy and how those are all interrelated. But really, the spike in inflation in 2022 resulted in really large deviances in asset classes, and global equities underperforming SA equities quite a bit, but risk assets not doing really well. And I think also in 2022, you had the likes of bonds doing poorly too, because as inflation went up, central bankers tried to fight inflation by raising interest rates, and they did so really, really quickly, probably one of the fastest interest rate hiking cycles in the last 50 years at least. So it really was a sudden change in the environment for financial markets, and they had to digest all of that very, very quickly, and that resulted in a negative movement. But that negativity of 2022 almost followed through to 2023, and it was the first time that Wall Street had predicted a negative outcome for the S&P 500 at the end of 2022 for 2023. So going into 2023, Wall Street analysts, and they're usually quite an optimistic bunch, and they're actually there to sell equities. They were expecting equities, the biggest stocks in the US market, to be negative for 2023, and they got that horrendously wrong. So you can see here in 2023, actually, is global equities up again 31% in rand terms, and the rand weakening by 7% as well. And once again, unfortunately, South African equities generating a return of 8% and SA properties 10%. But what I've got on the right-hand side here is what happened in the last quarter of last year. And you can see that there was actually really, really strong growth in certainly risk assets in the last quarter of last year. And particularly in South African markets, where pretty much the entire year's return for South African markets was made in the last 2 months of last year. So we really had a strong bounce in markets that helped South African, certainly South African markets, but also global markets. And actually, it was really taking lead from global markets. And I'll talk a little bit more as to what actually were the drivers to that. So if we move to a US dollar lens now, so previously I was looking at rand returns, now I'm looking at dollar returns. If you remember last year, global equities were up 31% in rands. And here you can see the all country world index, which is global equities, for 2023 was up 22% in dollar terms for the year. And here you can see this really strong bounce up from essentially the end of October to the end of December. But this was driven by developed markets, and I'll speak a little bit more to that. And unfortunately, emerging markets, and that's where we sit, struggled quite a bit relative to developed markets over here, with emerging markets only up 10% in dollar terms. But I think what's really important to mention is that despite the Wall Street analyst predictions, we got off to a cracking start to 2023, up almost 10% in short order. But towards the latter part of the first quarter of 2023, it feels like it was a really long time ago, but we actually experienced 3 of the biggest 5 banking failures happen in America in that first quarter. And that was the likes of Signature Bank, Silicon Valley Bank, and First Republic. It was all driven for certain reasons that don't have much time to go in there, but it's really good to contextualize where we were in the first quarter with a lot of stresses, certainly in regional banks within America, that caused quite a bit of jitters in the market space, and then in the context of the Fed still raising interest rates through that stress. But despite that, you still had global equity markets producing, and certainly developed markets producing, really strong returns. Now, if we have a look at which regions did well, so this green line over here is North America. So this is developed markets, this is North America. The orange line is Europe ex-UK. And this is United Kingdom, Japan, and then Pacific ex-Japan, which includes the likes of Australia, New Zealand, and Singapore and Hong Kong. But basically what I'm trying to show you here is that North American equities, the US and the S&P 500 really drove global equity markets last year. So although global equity markets were up 22%, US equity markets were up 26%. And every other region struggled to keep pace with that. And that's actually been something that's been a trend really for the last decade. When it comes to emerging markets, and this is where South Africa forms a part of, you can see here that emerging Asia really underperformed the broader emerging markets, and that's despite emerging Asia being around 2/3 of that index from a market cap perspective. But really that was driven by really poor performance from China. And this is also something that has followed on from essentially from 2021, where China has been a persistent poor performer. And China's quite a big influence, certainly on the South African equity market itself, because we've got the likes of Naspers Process that's listed on our stock markets. A big part of that is Tencent, which is a really big technology company from China. Also, China, a big driver of commodity demand. And so when China kind of sneezes, and we certainly feel that, and we almost catch a cold. So China's lack of demand, lower consumer sentiment, and business and investor sentiment has definitely spilled over to South African markets and emerging markets as a whole. And here you can see that quite starkly, because Latin America and EM Europe really performing, almost producing returns of 30% plus in dollar terms over the last year. So emerging markets Europe is very close to the Russia-Ukraine conflict there. So it's almost like something that you wouldn't necessarily expect, given the Russia-Ukraine conflict continuing there, but really speaking to how cheap it was before and things looking a little bit better from an economic perspective. And here you can see South African equities essentially flat for the year with quite a bit of volatility. Now, if we look at what happened over the last 2 years, because I was just looking for 1 year and providing a little bit more context, if we include 2022, in fact, global equities are pretty much at the same place as where they were over the last 2 years in dollar terms, and emerging markets are still backwards by around 12, 13% in dollar terms. So although we had a really strong 2023, that 2022 was very, very difficult, and actually we're in the same place over 2 years from an investment performance perspective. Now, looking at it, global bonds, also riskier bonds performing better. So this would be your emerging markets, emerging market high yield bond funds, investment grade corporate bonds, and so on and so forth. And you can see here, the higher the riskier the bonds were, the better they did in 2023. And then you can see in red is the South African bond market over here in dollar terms, and you can see how really we struggled at this point over here, and this was Lady R saga, and we really got punished. But ultimately, South African bonds in dollar terms also flat over the year. Global bond markets in general up around 4.5%. Over the last 2 years, though, you can see South African bond markets flat, and then global bond markets actually still struggling from that 2022, where global bond markets fell just as much as global equity markets. So quite a large overhang from the 2022 still filtering through in the global bond market. And what's caused that? And really what that is has been interest rates. So what I've got here is the Fed funds rate going back to 1993, and you can see this very, very quick and sudden movement in interest rates in 2021 and 2022 that took us to around between 5.25 and 5.5% in short order. But here you can also see the changes in Fed expectations and also market expectations from the end of Q3 to the end of Q4, and that's what drove that big bounce towards the latter part of last year. And you can see generally interest expectations fell quite a bit. But I think what I really want to mention here is how different markets are expecting interest rate paths to go versus the Fed. And that's actually just going to be a source of volatility throughout the year. And to show that a little bit better, what I've got here is the expectations of Wall Street expectations of where interest rates are going to be for 2024, how much they are going to be cut. So there's one thing that all these guys can agree on, is that there's going to be cuts this year. They just don't know how much and how quickly and when that's actually going to start here. So you can see the large discrepancies over there. But I think what's really important to know is that generally where we are from an economic standpoint is we're at the top of the hiking cycle. The next likely move is down. We just don't know how quickly and when that will actually happen. And the market is betting against the Fed, and there's quite big divergences between those two parties, and that will be a source of volatility. And we really have seen that play out certainly over the last 2 years and coming into 2024 as well. And just to show how quickly the market is also changing as well, so you can see here towards the end of 2023, the market was essentially pricing in a 25 basis point cut in March by the Fed. And then all of a sudden that dropped down to around 15 basis points and came down to 10 basis points. And this is remaining fluid, and things are changing. And in fact, we had data coming out on Friday that changed this again, pushing out those expectations to be later on in the year. And that really is being a big driver of essentially all asset class movements, because interest rates are almost like your risk-free rate, and every single asset class or instrument is priced as that being the base of the of ultimately the way in which you price any kind of asset. Now, let's dig a little bit into US equities, because there's been quite a big discrepancy of how different stocks, individual stocks, have performed within the US markets themselves as well. So, as I said, US equity markets up 26% in dollar terms for the year. But the S&P 500 X, the biggest 7 stocks, was actually only up around 12%. So now, what we can see here is that additional 14% came from the biggest 7 stocks on the S&P 500. Now I'm going to talk a little bit about that. But those biggest 7 stocks were up 107% in US dollar terms. Now something like NVIDIA, which is ultimately a semiconductor company, very, very much a part of this artificial intelligence theme that's playing out, and what that might mean for corporate profits and really the economy as a whole, etc., benefited from that massively. Happens to be one of the biggest stocks in the world, and it was up 200% last year. Then you've got the likes of Tesla, Apple, Meta, Microsoft. All of these really massive companies drove this performance. What this is saying over here is that if I were to equal weight S&P 500, so it's not a market capitalization sort of weighting, every single stock, it's 1/500, every single stock has the same weighting in the index, and then I were to do that for S&P 500, which is US equity market, the large cap US equity market, versus the rest of the world, is actually the average company, so the average company outside of the US actually outperformed the average US company. It was just that Magnificent Seven exceptionalism that really drove the returns of the US market itself, which was great if you had those kinds of stocks. But now you've got to think to yourself, what does this mean on a forward-looking basis? And I'll start touching on that now. So these are some extraordinary numbers. So the Magnificent Seven here, and I've mentioned some of these names. I don't think I mentioned Amazon, but ultimately they have a market cap value of $12 trillion. Okay, and the next 42 companies on the US S&P 500 has a very similar market cap of 12 trillion. Now, let me put that into context. That 12 trillion market cap is bigger than the GDP of Africa, Latin America, and Oceania. So essentially, you've got 7 companies that have a market cap bigger than 3 continents. That's quite extraordinary. But I think also what's interesting to note here is that Magnificent Seven has registered turnover or sales around 1/3 of the next 42 companies, and profits of around half of the next 42 companies. Now, what is that telling you? It's telling you that the market is expecting really big things from the Magnificent Seven, and that is already in the price because it's in their market capitalization. So that's definitely something you need to keep in mind in the future. And that's ultimately what I'm showing here is 12-month forward earnings expectations for the biggest 7 is around 30%, and for the rest of the market is actually below 10%. So the market is really pricing in magnificent stuff from the Magnificent Seven, and they're expecting it to continue to happen. What I've just got here is what market capitalization weightings were in the .com phase, and what earnings, what their contribution to earnings were, and what it is now. So these biggest companies are forming a really big part of these indexes here, and there's big earnings expectations within that. So if we look at this from a valuations perspective, and we look at different regions, you can see here the world is pretty much fairly valued. Remember, global equities have done nothing over the last 2 years, but they have grown earnings. So ultimately, that's gone into the valuations, and I'll touch a little bit onto that. The only region that's overvalued relative to the history is US, and then everything else is actually relatively cheap, especially the likes of emerging markets, UK, and China. And here you can see just like the discount of China versus the US. Essentially, you can buy China market for half the price of the US market right now. And this has been happening, as I mentioned, for more than a decade now. The US has just gotten more and more expensive, and everything else has just gotten cheaper and cheaper and cheaper. Now, I think what's really important is valuations almost forms like a natural law. It's like gravity. It's something that takes hold, and it's definitely from an investment perspective something that you have to be acutely aware of when you're making decisions that involves the future, because ultimately the way in which you invest now is for the future. So what happened in the past is actually almost irrelevant. You need to know what's in the price right now and what that means from what your likely expectations can be for the future. And I'm going to touch on that a little bit. So on this x-axis over here, I've got forward price earnings ratios, and then the subsequent 1 year return. Okay. So basically what this is saying for this dot over here, you had forward price earnings ratios of around 14, but the subsequent return was negative 40 over here. But also you've had other data points where it was plus 40, almost plus 60 to minus 40. Over a 1 year return, forward 1 year return, there's almost no relationship. So valuation is almost as meaningless. It's actually not going to help you all too much. But now if I look at it from a forward 10-year returns, you can start seeing this gravity, this natural law starting to take into place. And what that really is your higher your entry point from a valuations perspective, the lower your forward expectations need to be from a returns perspective too. Now, as you start thinking about your positioning of your portfolios right now and the fact that some things are really expensive versus some things not that expensive, you really need to start considering that when you start building your portfolios and what that might mean from a forward-looking perspective on returns. And this really just brings the point home here of the S&P 500 top 10, how much more expensive they are than the rest of the S&P 500. And that's the remaining US stocks. So US at the face of it looks really expensive. It's actually just driven by the biggest of the biggest stocks out there. What I've also got over here is as I said, we're in this situation where we are looking at interest cuts in the likely in 2024, and this information is looking at the past. Okay, what did markets do after the last Fed hike over here? And what you can see is actually in the whole, equity markets did relatively okay. There was just a period over here in the sort of .com where it didn't do all too well, but bonds certainly did really well at this kind of environment where you're seeing interest rates starting to fall over here. So you can start considering a number of things. Valuations is one of them. Where you are in the cycle, what an interest rate cutting cycle might mean on a forward-looking basis, what has happened in the past, but then you really need to consider what other risks are out there too. And big risk that's going to be in markets is the fact that over 4 billion people are going to the polls, including us. Biggest one of them is the US, India, Indonesia. Europe is going to parliamentary votes as well. We've had some that have already happened, like Taiwan, etc. This is just going to imprint a little bit more uncertainty into markets, things moving around a little bit more than what you'd expect. There are some other large global risks, and this is almost like a theme coming through here. And this is data coming from a survey of 1,500 of global leaders and what they're actually worried about. But the fact is, there are billions of people going to the polls, and people are worried about misinformation, political polarization, AI-generated misinformation in particular, and how this can feed through into social media platforms, etc., 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 and cause real-world changes in leadership, what that might mean for countries around those countries that make those decisions, and geopolitical risks in the context of where we have conflict in the Middle East already, and Russia, Ukraine still going on in that region too. But we need to stick to the basics. We don't really know what's going to happen geopolitically, politically, etc., etc. We do know inflation, disinflation has taken hold. Future rate cuts is the likely path in which we're going to go. We still don't really know how the economy is going to react to what has ultimately been a very, very quick and sudden and strong, aggressive interest rate hiking cycle. And actually, for the way things have panned out, is the economy, especially the US economy, has absorbed that extremely well for now. There are still risks of this coming through, but for now, the US economy is still doing quite well, and ditto for the rest of the world. I think our guiding light actually needs to be valuations ultimately. And this is what the Cinnabar Investment Committee really focuses on over here. And what I've got is various asset classes over here, and there's Z-score, which is basically just a standardized measure of history of an asset class, and whether it's expensive above the average or cheap below the average of its relative to its own history. And what you can see here is basically relative to the end of 2021, which was two and a bit years ago, markets are cheaper almost across the board. Our starting points is actually cheaper than it was 2 years ago, which is a good thing. I mean, it's actually a really good thing to be investing into the same asset classes, the same assets, but at a cheaper price. Basically, what this is telling you, and what that means is forward returns is going to be better than what they were kind of showing you at the end of 2021. Yeah, and here again you can see a lot of that overvaluation is very much concentrated within the US, and certainly US large cap growth. So that was a quick whistle stop tour. I'm finished now. I'll stop sharing, and we can carry on with I think it's going to be Geoff after me.
Thanks, Brendan. Thanks very much. Are you able to stick around for some questions at the end?
Yeah, sure. I'll stick around.
Okay, thanks very much. In that case, it's not going to questions now, but I'm sure there are lots on people's minds after that presentation. Very interesting. Geoff, over to you.
Cool. Thanks, Brendan. Thanks, Alex. Morning, everyone. I'm going to go through mine relatively quickly for two reasons. The one is that you're going to get pretty bored from the messages that we always bring you, because one of the things we always talk about is consistency, and in that you'll see through our investment philosophy, I'm going to remind you what we do and how we do it, but you'll see that nothing much changes, and then also talk about some of the funds and the changes that we've been making in the funds. But it's a nice report back to have, namely because we actually see our growth assets doing well over the period under review, as Brendan and I have mentioned, and the fact that the funds are also doing well. But let's go back through to the reminder of our investment belief system. And remember, this is just the way we see the world, and we use this almost as our philosophical guidance as to how we want to invest and what we want to do. And this underpins the construction of our portfolios. It underpins the way we select and blend managers. So over the time, obviously, all investors want to have long-term outperformance, whether that's due to inflation or whether it might be versus peers or indices, whatever benchmark that you want to measure yourself again, achieving your financial freedom, for example. And there's basically 4 rules that we try and apply in our world. And the reason why we create the rules is because we always want to take emotion out of the investment decision-making process, and hence this anchor that you can reference back to in your philosophy. So the first one is win by not losing. Now, people often, always talk about the winners. We've got the Super 7, and did we invest? What about Tesla? But remember, risk is often symmetrical. In other words, for every winner at the top, there's also a loser at the bottom. And over time, we think it's as important to try and avoid the losers or the losing asset classes, the losing investments, the high risk investments, because while they might promise an outcome at the top, which is attractive, you can end up underperforming in the long term. So the first one is win by not losing, just avoid the bombs. The second one is remove or reduce what we call single factor bets. Now, later on I'll talk about diversification, but you might build a portfolio of 100 stocks and you think you've got the best portfolio in the world. But if every one of those stocks is linked to interest rate directions, or if they were in South Africa and every single one of those stocks was a Rand hedge stock, for example, but the Rand got stronger, you might find then that you underperform. So while you might feel that you've got diversification or spread your risk, you might actually have single factor bets in the portfolio, macro single factor bets in the portfolio. And again, this also goes back to the win by not losing. Make sure that you don't have a dependency on one outcome. You want to have a dependency on many outcomes. And that then goes through to our third tenet, and that is diversify risk and diversify risk exposure. So yeah, we actually thrilled to have the Super 7 stocks in our portfolios. We're thrilled to have some of the winners in the portfolios, but we haven't created a dependency on them. We've actually again diversified across the marketplace. And then the final one is you just want to outperform a little bit every year. And some years you're going to get it wrong, and some years you're going to get it more than right. But again, it goes back to the win by not losing. If in 1 year we build a portfolio that outperforms the benchmarks by 10 or 15%, I would be quite nervous, because that actually means if risk is symmetrical, there's a chance the next year we could equally do as poorly. So I'd rather take consistency and small incremental gains and bank on those every year than trying to hit the big winners and hit it out the park, because it will probably go wrong at some stage. And all of this, we think, just leads to long-term outperformance in what we are going to present today in the portfolios. Cameron, can we go ahead to the next slide? Sorry, I have no control over the slide deck here. That philosophy is against the backdrop of the one free lunch. And again, those that regularly attend our seminars and report backs will know that we always take about the one free lunch. So amazingly, all of the clever work in the Brains Trust, not myself, but everyone else in the room on the investment committee and across Cinnabar, spend a lot of time thinking about where to invest, how to invest, what are the right options for our clients. But the reality is that, call it 91% of your long-term investment returns are determined by your strategic asset allocation. What is your long-term allocation to equities, bonds, property, or cash? And you saw in that example earlier on for that modeling, when we modeled for that one investor, and we moved from cash to equity, suddenly instead of 5 million rand at retirement, 8 million rand. So all of the smart things that we try and do actually only count for the stuff in gray, which is about 8%. And it's quite sad for us, but it just gives you the importance from a financial planning perspective, an investment perspective. If you get your long-term asset allocation right, what suits you in terms of your risk profile, your return objectives, where you want to be at 65 or 70, then the rest is actually the cherry on the cake. And really what we try and do is focus on the stuff on the right. But we also then you'll see in a moment as I present how this goes through back to your strategic asset allocation. So perhaps you can go on to the next slide. So how do we guide our clients and how do we construct our fund range with reference to the strategic asset allocation? Because obviously we have different clients and investors that have different risk profiles, return objectives, tolerance for losing money, life goals, etc. And we essentially see three types of asset classes in the world. And I'm not, before I even talk about property, bonds, or onshore, offshore, rands, dollars, pounds, hedge funds, etc. We really see the fact is that you have defensive assets, assets that protect money, don't go down or try and go down in tough times by small amounts, and typically give high yields. Those would be your income, your low, let's say your low risk defensive assets. And then on the other side, you get your growth assets. These are assets like stocks over time. These are going to outperform the stock exchange, outperform inflation, and create wealth. But with that growth comes volatility. And then we've got what we call flexible assets, which is a little bit in between. And these would be investments that can move around from equity to bonds to cash, and or just sometimes pick interesting opportunities. And as you can see, when we build our fund range, we start with the conservative income generating type portfolios, which are defensive, right through to our more aggressive portfolios, the Balance Plus range, for example, which is still Regulation 28 compliant. In other words, it's still a spread across all assets for pension type investments, and that will have some growth assets and some defensive and flexible assets. But as you know, as you include more growth assets in your portfolios, your return rises in the longer term, but also your volatility. So the ride is less smooth. And you'll see when we present the range now and the returns that we've had, how our portfolios have behaved compared to that. So once we've now got our sort of philosophy and our belief system, and we know how we structurally want our portfolios to look, we start with what I always refer to as the onion. your starting point, for example, is the strategic asset allocation. How much do you want in growth or defensive assets? But that's not sufficient. Once you then know what your definition is of what you're looking for in defensive and growth assets in a portfolio or a unit trust or a fund that we manage, you then say within those the growth and the defensive asset, what are the sub asset classes that you might be interested in? Real assets or fixed income or equity or flexible. Once you've selected the sub asset classes, you can now go even drill down a further layer and say, well, now that we've decided how much we want in growth, and within growth, how much in equity, within equity, well, how much in South Africa or developed or emerging market equity. And once you've done that, you can then go and look at your managers on top of that to see which managers do you want to go and pick the stocks in South Africa equity for you, or which tracker funds you might want for global equities or in real estate. So you can see that there's a continuum starting all the way back to referencing our strategic asset allocation right through to the blending and manager allocations. And it's this layer of onions that we think gives our portfolios the defensive nature that we require. And when I say defensive, not in poorer returns, but in that they follow our four tenets. Win by avoiding the losers, diversifying the portfolio, no single cap, no single factor risks. So if I move on then to what we've done in the last 2 years, Brendan will have taken you through the strategic thinking and guidance of how you see the world from a macroeconomic perspective. It's what stock markets are doing and interest rates and potential returns. But we need to drill this down. And Brendan would have shown you in 2022, it was a terrible year for growth assets. So you can see here from the left, income assets did better than your growth assets on the right. And going into the end of 2022, it was interesting, as Brendan said, all the forecasters said 2023 is going to be a terrible year for equities and growth assets. But if we go forward, Cameron, you'll see the exact opposite occurred. And so in 2023, we started experiencing a recovery in your growth assets. And this is what your normal longer-term risk profile should look like. On the left, your income or your defensive assets will give lower returns. On the right, your more aggressive assets, your growth assets will have higher returns, and the portfolios on the right have greater exposure there. But you can see here that obviously in the poor year of 2022, the income fund still did okay, and the stable fund still did okay, whereas the equity-focused funds actually had negative returns. But we're very pleased that markets, if I want to call it, are behaving over this period in a more normalized fashion. But there will be times again when your growth assets underperform. So let's now go perhaps and drill down then to understanding what worked for us and how the funds performed. So across the managers that we use, we have exposure to 11 underlying managers across various portfolios. Remember, within, for example, PortfolioMetrix, although we pick them, they also have different managers within their sub-portfolios as well. And I'm pleased to say that, out of the 11 managers that we have that help make up the funds, and most of these managers, in fact, the vast majority, I think only 2, if I get my maths right, actually, or 3 underperformed or were in the second half of the performance numbers. So that's actually really attractive for us. It's a nice hit rate. I would caution and say that to get that hit rate, if we could do that every year, would be wonderful. But I suspect that some years we're not going to have that level of hit rate. But this worked well for us over this period, so we'll take it if we can get it. So let's run through our unit trusts from our local funds, and then we'll talk about the global funds. So again, our income fund, a conservative fund there, its benchmark is inflation plus 1%. We were pleased over this period that it was actually ahead of the peers and gave a return of roughly 9.5% or so. We were very comfortable with the fund, and we made no changes within the fund from a manager perspective within the fund. Our stable fund, now that's got a 2-year horizon, so it's meant to give slightly higher returns than our income fund. It's got a little bit, it starts introducing some growth assets or into the portfolio, namely equities. And again, we're pleased to see that it's ahead of this period. It's benchmark of inflation plus 2, and also the peers. There was one Small change in the portfolio. Remember, I spoke about the strategic asset allocation making up 91.5% of your returns. And then there's the gray stuff on the right, which is stock selection, tactical asset allocation, manager selection, blending, all of that. We made a small change last year, and that was we actually started, and you'll see this theme through the portfolios, is into Rand strength. Through the year, we started taking some South African equities off the table and gently introducing global equities into the portfolio. And this portfolio, a very small change, took 1% off the table in South African equities and 1% into global equities. In our balanced fund, our benchmark there is CPI +3. Again, we're pleased that over this period, it was ahead of that as well as the peers. And again, the same theme throws through is that we've been reducing, and I will show you some slides just in terms of our asset allocation with respect with relating to equity. But you can see here, again, a little bit off the table, 1.5% off the table for South African equities, and using the dollars, the Rand strength as the opportunity to move into global equities. And then our Balance Plus fund as well, exactly the same story. Again, pleased with the performance and so some of the small changes we made in the portfolio. And then finally, our flexible fund of funds here, no changes to that portfolio. The portfolio is behaving well. We're very comfortable with it, and it gave a return last year comfortably ahead of its inflation +5 and peer group. Next one, our worldwide flexible fund. Again, sorry, the story, as I said at the start of the presentation, a little bit boring, but again, we're comfortable with the performance here. It's done well versus the peers as well as its benchmark and inflation. And we made no changes to this portfolio. So if we had to say, where are we moving to, and where have we come from in the portfolio? We mentioned in our local portfolios, remember our local portfolios are for local investors that are investing in rands. We've indicated for the last sort of year or so, year and a bit, that our intent is to reduce South African equity in favor of offshore equity. So our longer term benchmark in terms of South African equity is to have less in South African equity and more in offshore. So at the start of Q3 last year, you'll notice we had 58% in South African equity. And again, using incremental changes, we reduced that down to, I think, Cameron, you can take it forward, I think to 55%. And so that trend will continue. People say, well, why don't you, if you want to increase global equities, or you want to take money off South African equities, why don't you just hit it in one go? So the problem with that is, imagine if we'd hit it at one go when the Rand was at 2050, 21 to the dollar, and we've traced all the way back to 19. Likewise, what if we hadn't moved and the Rand suddenly strengthens to 16 Rand? And so part of these gradual shifts is that we actually would rather, some of you that will remember the old days of stock market investing that spoke about Rand cost averaging, where you bled into a position, you slowly bought into a position or sold out of a position, rather than taking a single decision at a single point in time. And that's part of the risk mitigation, because remember, when we talk about risk diversification also talks about your decision-making diversification, that if you moved your whole portfolio in one go to a new position, you're taking a single point risk because you're setting those prices across the portfolio. But we'll continue to drive this and sell out of local equities into global equities. The source of what we'll be selling out is across all the local portfolios is we'll be reducing our exposure to the Satrix Top 40 Index. That is a basket of the largest 40 stocks in South Africa. And when we buy global equities, we're putting it be roughly 90% of every Rand we sell out of South African equities. We'll put 90 cents into the MSCI World Equity Index. So that's going to buy a basket of global equities. And at the same time, we will put 10% into emerging market equities. So as I'm speaking, it's like magic. The slides change. but that's just because Cameron's doing a good job leading this. And then quickly to talk to our global range. Remember, this is for investors with money offshore already, and they're buying into funds in dollars, well, not in rands. So our global balanced portfolio, the main change that we had recently was we sold out 15% of our exposure to the US stock index. So that was, and we'll explain in a moment, but we had a 15 exposure directly to US equities. And we've moved that into 7.5 and 7.5 into a global Vanguard Global Equity Index portfolio and the PortfolioMetrix Global Equity. Now remember, 15% was fully exposed to the US through that US fund. The two new funds that we've introduced here have roughly, between them, roughly 60%, or let's call it just over 60% still exposure to the US. So while it looks like we've taken 15% off the market, what we've actually done is we bought two funds that introduce a bit more global equity. So net for net, we've taken the US down, but not by the 15%. It's probably down by about, in fact, you'll see it in the next slide where we've dropped the US exposure somewhat. And part of our thinking of reducing our exposure to the US is aligned with, I think, some of the interesting stats that Brendan spoke through. So at the start of Q3, our global, the equity component in the global portfolio had 75% exposure to the US. Okay. Now the index for the US is 63.8% of global equity. And so what we've been doing is we've been reducing down our exposure to through this move of the 15% sale, just to reduce our exposure to North America. We are still overweight North America, but I think we've had a good run in our exposure to the whole market, in particular those stocks that have done phenomenally well, the ones that have nearly doubled in the last year. And then based again on this, the reference to valuations is and global valuations that Brendan mentioned is that we are starting to look at other areas in the globe that are starting to present interesting value opportunities. But there's an interesting analysis here. So while the US makes up 63.8% of listed, or let's say North America of listed equity, and we're at 67.4%, remember a lot of companies that are listed in the US, I think Cameron, you can go forward, actually have their earnings outside the US. You know, Apple doesn't only sell Apple in the US. So interestingly enough, while the US actually makes up 65% of listed equity in North America, listed equity in the world, if you actually break regions down by the revenue, where do those companies in the US that are listed, you know, what is the source of revenue? And we actually see that from a revenue perspective, the portfolios actually only generates 47%. Those companies we invest in, although they might be domiciled in the US, only 47% of the revenue comes out of the US. And so it's not just a straightforward to say, oh, gee, okay, Asia's cheap and let's actually sell down. We need to take care of just where the revenue is. So this is just an interesting dynamic that we're playing out. But the general themes will be reduce South Africa further, use Rand strength to exit into global equities, also take some money off the table in respect of the US. The problem with the US is, especially if you're buying an index fund in the US, is that a large part of that index fund is exposed to the very expensive, but very public companies. But you also got a part of the US which is actually attractively valued. So if we pull that all together, we're pleased to feed back across the portfolio range just to show that the funds in 2023 were ahead of their targets in terms of their inflation-linked targets. And we were very pleased with that, some of them very, very handsomely. So I'm pleased to see that there's a green sweep across the numbers on the right. Like, maybe one day, when you have a nice report back like this, it's also worthwhile mentioning not all report backs are going to have good numbers like this. Not all report backs are going to say, well, 9 of our 11 managers actually were in the top half of performance. And not at all times do growth assets behave like we want them to do and give handsome returns. But I think that this just demonstrates, I think, through consistency in the long term, these are the types of numbers and performances we'd be bringing you, notwithstanding occasionally a little bit of red on the right. And with that, I think I'm handing over to Zahid.
Geoff, yeah, thanks so much. So I'm personally very grateful for the trust Alex and the team have in me, and I'm excited for what this coming year holds for us at Cinnabar. We are growing in team and ambition, and I'm really looking forward to making a meaningful, positive impact on our clients and partners at the industry at large. As I bring this morning session to a close, I'd like to highlight some of the notable achievements that will set the tone for our focus for the year. The launch of our Global Equity Fund represents a significant milestone in our commitment to providing comprehensive investment solutions to our partners and their clients. With the introduction of this fund, we are expanding our product offering to encompass a broader spectrum of investment opportunities, thereby enhancing the range of options available to our partners. The Global Equity Fund is designed to capitalize on opportunities in the global equity markets, offering our investors exposure to a diversified portfolio of stocks from around the world. By investing in companies across various regions, sectors, and market capitalizations, the fund aims to provide long-term capital appreciation while managing risk through prudential diversification strategies. Overall, the launch of our Global Equity Fund underscores our ongoing commitment to innovation, excellence, and client service. We believe that by expanding our product offering and providing access to a full range of fund solutions, we can better support our partners in meeting the evolving needs and preferences of their clients while helping them achieve their investment objectives over the long term. Here we've partnered with a marketing and communications company to develop our brand communication. This will help us continue building our brand awareness while creating topical and insightful content, which leverages on the thought leaders and experience within the business to give it our uniquely Cinnabar approach. This will ultimately assist our partners with imparting knowledge, creating awareness, and nurturing more valuable relationships and engagements within their community and clients. I'm thrilled this year to have a roster of exciting and topical speakers lined up for 2024, including accomplished individuals ranging from professional sports personalities to individuals doing some revolutionary work in the fintech sector. We aim for each quarterly session to be as insightful and as interesting as possible, not only for the industry stakeholders, but also for our investors. Our Q3 session, featuring Victor Matfield, being just a few weeks shy of the incredible Springboks Rugby World Cup win, will be hard to top, but our team, as always, is geared up for the challenge. As always, we are consistently refining our value adds to our partners, and I'm excited to announce that we will spend 2024 sharpening our additional support functions, which form part of the growing Cinnabar ecosystem. Our book risk analyzer tool in particular has seen a huge uptake, with many of our partners finding it a necessary risk mitigation tool that adds an extra tilt on both understanding and managing their clients better, while adding an extra layer of regulatory compliance to their practice. This insightful tool is a product of many months of development and fine-tuning from the team here at Cinnabar, and we are very proud of what has been built, and importantly, how it can benefit our partners and their clients. 2024 looks to be an amazing year for us at Cinnabar, and I'm glad to be part of this team.
Thank you, Zahid. Well done on your first presentation. Excellent. Yeah, it's good to have you in the team as well. We've got a number of questions. So before we wrap up with the last few slides, I think if we can open the floor to the questions, I'll go through them. So the first one was from Joshua, and yeah, Brendan, I think this is directed towards you. In fact, it looks like most of these questions are directed towards you. So it is: do you expect the 10-year run from the US to continue?
Yeah, who knows? Maybe, but I think what you need to just be cognizant of is what's already in the price, and I think that's what I was trying to allude there is in order for the US market, and sorry, I love what Geoff was talking about there in terms of showing revenue distribution versus market cap, and the same goes for US. I mean, the US is such a lively economy and stock market, and there's so many investable opportunities. It's not all just about those top seven stocks, and there's a bunch of different opportunities within that market itself. But the fact is that those big 7 stocks make up 30%. And what I was trying to say is that from this starting point, it would be unlikely, really, because it's a really, really high hurdle to meet the demands of what investors are wanting on a forward-looking basis from those kinds of companies. And that's all you can, I mean, that's all you can really use as a guideline. We don't really know, not many people really know what new technologies and what affects the likes of an artificial intelligence, et cetera, et cetera. But there is a hell of a lot in the price.
Yeah, yeah. There's room to surprise on the downside. Brendan, another question directed towards you is, have you put any contingency plans in place within the portfolio, or are you likely to change the portfolio for based on the election results?
So are we likely to change based on or in the lead up? No. And contingency plans, I think this is like a fundamental part. And again, it's what Geoff was speaking about earlier about strategic asset allocation and remaining diversified and trying to build consistent portfolios and chipping away at your return or investment objectives. Diversification and smart diversification is certainly your best defense to what ultimately is an unknown future. I mean, at the moment, we have the luxury of looking back in the past and we see how things have performed based on that, but that was only one potential sort of outcome, okay? And at the moment, we're looking forward and we're looking at many different versions of a potential future, and so you need to build a portfolio that has a strong enough chassis to sort of ride the bumps along the roads, and that speaks to strategic asset allocation, diversification, having multiple sources of returns and risks within a portfolio that if something unexpected happens, it's not going to blow you up. I think if you start, there's 2 issues with positioning portfolios on the basis of an election outcome. Is number one, first of all, you need to get the outcome right. Okay, so you expect X, Y, and Z to happen, or this party or this individual to win, which in itself, I mean, as you can see with even with the American elections and ourselves and anyone really, there's a lot of uncertainty around that, and you can have unexpected results. And then number 2, even if you do get it right, quite often the markets can behave in very different ways to what you would actually expect. And there's 2 examples I'll give to that. As Brexit was unexpected, the people that did take that risk into account, like UK investors, took their chips off the table and went into UK cash, which is pounds, and then Brexit happened and the pound fell by 15-20%, and ultimately they blew a hole in their portfolio. But what they thought they were doing was de-risking their portfolio based on an outcome of that. So that's a bit of a concern. Then you had Trump again in 2017, and people were viewing him coming in. First of all, it was a surprise, and then also they were expecting it to be overwhelmingly negative, just given the character. But I mean, he pushed through a whole bunch of corporate tax cuts, etc., and ultimately we had a magnificently strong year, certainly, and markets did very, very well subsequent to that. So I think if you have an investment strategy where that is your competitive advantage, predicting what it's going to happen in elections and then positioning for it, I think you're in for a hiding to nothing. You're definitely going to systematically lose value for the clients. So we would not do that.
Thanks, Brendan. Good answer. Geoff, a couple I'm going to combine to direct towards you. The first one is prepared to hazard a guess on the dollar rand this year, and should one get as much offshore as possible? That's from Brian Horwitz. And linked to that is another question, which is at what levels are you nibbling away at that dollar exposure within the portfolio?
Look, so I think currency forecasting is a fool's errand, but it is something we have to do. And maybe I want to just go back, maybe just to and I will answer the question, but just to give a point of Brendan's observation. When we deal with the past, you have I don't know, something happened last year and it happened, and there's a single factor. You knew that happened and had a consequence. When we're trying to forecast the future, there could be 10 outcomes to an event. Okay, you just don't know, and you've got to forecast which outcome is correct, but then understand the consequences of that event. So hence, for those that are old and got some grey hairs, remember, Clem Santa and all his high load, low road scenario and forecasting scenarios. So I think at the end of the day, you've got to sort of understand scenarios and understand, well, what are the various themes or circumstances that can play out, and then assign sort of probabilities to that. But the problem is, even if you reduce the world to 3 scenarios or 2 scenarios, you still got to make a call on which scenario. So if I had to bring that back to us, I think that we probably the upside, and I say this strangely, but I think that the risk that we face at the moment from a portfolio positioning is actually rand strength. And why do I say that that's a risk? Because normally you think rand strength, that's a good thing. Is that generally, as South Africans, we do position our investment portfolios over a long-term rand decline, because that's our history. And our history relates to 2 things. The one is that we run high inflation rates in the rest of the world, so you're going to get a natural decline. The second aspect is we've attributed the rand over time to try and work out what are the 3 drivers. And in fact, it's almost a third that drive the rand. The first one is US interest rates. The second one is the global commodity cycle. And the third one is what we do domestically in South Africa. Okay, and that might be the perennial shooting ourselves in the foot once a month or once every 6 months. I don't know whether. The problem is that those 3 things at different times have different weights. And on average, over time, they actually sort of smooth out at about a third. So if I had to kind of just, if I gave that context, I think that probably at the moment we see rand strength, and that doesn't mean we're going to 12 rand. Maybe this is going to to 18, 17.50, 17. Not dramatic, and definitely we would look to use those opportunities to increase offshore. And I actually think that if the rand got a bit, if it actually had to sort of strengthen quite violently, we would probably move more aggressively to take the money offshore. And likewise, funny enough, if the rand was to weaken a bit, we would also take money offshore. Our strategy is around asset allocation, not trying to forecast the rand. So it's difficult to pinpoint, but I would imagine that in the next 6 months you would probably get maybe another 5% shift, driven by politics. Remember, there's also another decision, not just take the money offshore. It's actually to what asset class do you take the money. But our view is not to move aggressively and dramatically, because it can hurt you. The other one I just want to highlight is also not to move at points of extreme optimism or fear. In 2000, when I was at Alexander Forbes, we had clients when the currency blew out. At that stage, it went to 14, I can't remember, 12, 13 to the dollar from 7. And we had clients that shifted wholeheartedly every rand that they got out the country. And for the next 10 years, the rand strengthened. And by the way, people forget that from 2000 to 2011, US equity markets were flat in dollars, and the South African equity markets were up 3.5 times in dollars. Okay, so this is not always necessarily the one-way bet. And I suppose I'm giving a typical economist answer. Therefore, I'm copying it out and saying, guys, that's why you want to just be gradual and have an exposure to everything. But going back to the original question, if I was sitting on Mars and I was going to put my investments into the world, onto Earth, I probably wouldn't have 70% or 50% of my portfolio in South Africa. And this is not around a question of whether the rand's going to get stronger or weaker. This is just a question of that there are assets that you just can't buy in South Africa. This is around, if I want to get global exposure, I want to have a diversified basket. So over time, you do want to have this global exposure. And then the other point I want to make actually is the other reason why you want to potentially phase it in. So we see the rand strengthening, we want to take more money overseas, put it into global equities, is remember, we're typically selling South African equities, and South African equities might not have performed well, but on a relative basis, actually attractive. And so it's also what you sell. So a long answer to an easy question.
That's a good answer. I like that. I like that margin example. Not going to invest your Mars kids' money all in one little land mass in the southern tip of one continent.
And or would you put it all in Google? Okay.
Yeah.
Or Apple, or Alphabet, or
yeah. Thanks very much, Geoff. Brendan, back to you. Are we heading towards a Magnificent Seven bubble?
Yeah, look, again, I don't really know. But remember, I mean, some of these companies, these companies are investing. What I didn't mention is these companies spent $200 billion on research and development last year and $170 billion on capital expenditures. Now, put those two together, and that's the entire South African GDP. Okay, they are investing in building the future ultimately. They are investing heavily in certain technologies and tools and all of that to take ultimately our economy to the next level. So their dominance and also their power when it comes to holding data, which is essentially the new oil of the economy, they do have a lot of value within them, and we need to appreciate that. I mean, they haven't gotten to this position for nothing. But we also just need to be, and it's not to say now that you need to go into your portfolio and sell all of the Magnificent Seven, is you need to balance off, okay, what is the absolute risk that you are running by owning, well, like Geoff said, 100% in Google? That's quite a very specific idiosyncratic risk that you're taking within your portfolio. If you are doing that, it might be a great company, etc., but it's got a PE of, I don't know, probably 30, 40 or something like that, and there's big expectations within there. If they disappoint, you're going to have poor performance. So it's very difficult to call a bubble in the Magnificent Seven. They're there for a reason. They're building technologies and investing into their businesses. They have very sound balance sheets, huge amounts of cash on their balance sheet, which is good for a high interest rate environment, etc. But a lot is in the price, and I think you can also, what Geoff said is that there's a lot of opportunities outside of the Magnificent Seven. So you can diversify without completely selling and taking a very, very one-sided view, but you can stop moving the chips along across the table, if you know what I mean. You don't necessarily have to have a massive view. You can just appreciate the risk of either direction and what that actually means for your portfolio. And that's what I'd more sort of how I'd view it, as opposed to say I'm calling a bubble in the Magnificent Seven and they're way too overpriced and so I'm going to have zero. There's risks to that. There's risks to having zero because you'll have big relative risks that you'll be carrying within the portfolio, because they might just carry on doing well for the next 2 or 3 years. And you also need to be very cognizant of what kind of behavior you would have for underlying investors, if they underperform for a significant amount of periods and then they decide to sell and then they crystallize losses, and then you have a financial plan that almost gets ruined because of that. So yeah, it's not an easy question to answer and be very clear and say, yes, I think there's a big bubble, or no, I don't think there's a big bubble. I think there's a whole bunch of different scenarios in and around that, and you just need to be cognizant of what it implies by holding a particular position within that, and what are the risks associated with it.
Alex, if I might just add quickly, I don't think that they are like the dot-com bubble in the early 2000s, okay, where there was these businesses, where a lot of businesses were on 100 multiples with no substance behind them. These are good businesses with substance behind them. I think this is just a matter of valuation. So these businesses are going to be around for a long time. And I mean, you'll see the behavior in the portfolios as we're not selling out. We've actually been technically overweight to these businesses in the portfolio. And what we're doing in the portfolio is just taking money off the table and reducing some of the exposure to them. And I think that while I can't foresee risk here, I think there's two things that you need to be cognizant of. The first one is that given their valuations, these are good businesses, they generate cash, they reinvest, but their market expectations are high. So in 2 years' time, will they be more expensive than now? Probably. Okay. In 1 year's time, I think almost very highly. 2 years' time, probably. In 5 years' time, maybe they're the same price now. As earnings catch up. But they don't go away. The second aspect is that people I think are missing, and you're starting to see this out of the EU in particular, because the US seems to not have the stomach to deal with the not that they're monopolies, but they are monopolies. But the EU is starting to, I think there's going to be regulatory risk around a lot of these businesses where because they're so big and they're so dominant, they start introducing systemic risk into regions or economies. And some of the interesting reading I'm seeing is I think there might be slowly, but in time, there could be regulatory threat here where they actually get broken, where they get broken up. Recently, the EU has also made the move against for example, Apple's pricing. Okay, and Apple's allowing other products onto their platform, and they're actually trying to break that pricing monopoly. So it's small things, but yeah, are they around? Yes. Do you want them? Probably. Do you want them overweight in your portfolio at the moment? Probably not.
Yeah, good answer. I'm going to wrap up there. It's been a great session. I'll finish with answering just two questions. The first is, is the session available afterwards? And good news is we've recorded the whole session, so we'll make it available for anyone that you'd like to share it with. Going forward, please invite whoever you would like to these sessions. So we had 150 people register for this session, so it was a reasonably good sized session. We're happy to go a lot higher than that. So if you found it useful, share it. And then the second question was, which platforms are the Cinnabar funds on, and then how does one invest into the Global Equity Fund? The Global Equity Fund it's not launched yet, so it's not available. We would look to launch that hopefully in the sort of towards the second quarter of this year. But the platforms that we are available on is Glacier. Alan Gray have recently approved us on their platform. 91, Stanlib, Old Mutual, Momentum, PPS. And then, of course, many of our investors actually end up going directly to the fund through their advisor, because they then get the benefit of a discounted platform fee, where the platform fee is zero. So with that being said, I'm going to wrap up, given that we are at time. Thank you again for joining us. It's been our absolute pleasure, and we look forward to the next quarterly. Bye for now.
Thank you. Bye-bye.